Hey guys, if you're looking for stable companies to invest in the long term, then you will probably want to consider looking at Kroger. Founded in 1983, the company has since become one of the largest retailers in the world based on annual sales. As of the end of fiscal year 2020 that ended on 30th January 2021, the company recorded a whopping $132.5 billion in total sales. If you are located in the United States, you would probably be familiar with its supermarkets and department stores, but you might not be aware that the group actually operates a total of 2,742 supermarkets, 2,225 pharmacies, and 1,596 fuel centers as of the end of the fiscal year. Because the group operates not just under the Kroger brand, but also a variety of local banner names you can observe from the chart here. Part of the reasons for this myriad number of brands lie in the company's long involvement in the action of merger and acquisition activities. In fact, the company has been employing merger and acquisitions as its key growth strategy over the past years. The largest merger occurred in 1999 when Kroger merged with Fred Meyer in a $13 billion deal to create a supermarket chain with the widest geographic coverage and offerings in the food retailing industry. Latest merger involves Rowdy's, adding Pick and Save, Metro Market, and Mariano's stores in Wisconsin and Illinois to the Kroger family. With such a long history of successful operations and steady growth, it is no wonder why Warren Buffett wants a piece of stake in its business. But exactly what return is Buffett expecting, and if you also want to enter a position now, what kind of returns can you expect? Let's check it out. Geographically, the company operates only in the US across 35 states, hence the retail operations, representing about 97% of the group's consolidated sales, is their only reportable segment. The company's supermarkets operate under a few formats, namely combination food and drug stores, also known as combo stores, multi-department stores, marketplace stores, or price impact warehouses. Other than the different store sizes, their goods offerings are very similar, with some variation depending on the store types. They include full-size grocery, pharmacy, and general merchandise such as apparels, home goods, and toys. Because of this very similar product mix, distribution method, and sourcing of merchandise, we can see why the company aggregates its operations into a single reporting segment. With such massive retail operations, the company can rely on its size to negotiate for better pricing of its merchandise from its vendors. Not only that, Kroger is taking advantage of its scale to create their own private label products. This will allow the company to drive the cost of goods down and create more margin for its supermarkets. As such, the company has been actively seeking opportunities to create their own brands of products. Observe from the chart here, sales contribution from its private label items have risen steadily over the years from $15 billion in 2011 to $23 billion in 2019. On average, each supermarket stocks more than 15,000 of Kroger's own private label items. With such capacity, the company can create more cost savings by producing its own brands of items. In fact, about one-third of the private label items are manufactured from their own 35 food production plants, consisting of 16 dairies, 9 bakery plants, 5 grocery product plants, 2 beverage plants, 1 meat plant, and 2 cheese plants. The rest of the private label items are produced by outside manufacturers based on a strict specification provided by the company. Over here, we also want to highlight that Kroger has been actively investing in digitalization of its sales channels as well. It is not allowing other online e-commerce companies like Amazon to compete away its market share easily. We saw that digital sales, primarily consisting of pickup, delivery, ship, and pharmacy e-commerce sales, grew approximately 116% in 2020, 29% in 2019, and 58% in 2018. The outbreak of the coronavirus in 2020 has accelerated the adoption of Kroger's digital sales channel as customers are encouraged to shop their groceries and necessities online. Now we are ready to discuss why Buffett bought Kroger towards the end of 2019 and has been adding to his positions ever since. In the latest first quarter of 2021 Berkshire Hathaway's filing, we saw that Buffett added another 52% of his stakes in Kroger. And it is now worth a sizable amount of more than $1.8 billion in its portfolio. Let's take a look at Kroger's financial performance and see why Buffett thinks that it's a value buy. Observe that the company's sales have been pretty steady for the past few years. Fiscal year of 2020 saw a more substantial relative increase due to the impact of the pandemic as more people stay and work from home. Due to the effect of people dining out less often, the company's grocery sales had definitely benefited from the pandemic as people cooked more frequently at home instead. Notice another significant item in 2020, that will be its gain on investment, which added $1.1 billion to its bottom line. So to get the company's operational earnings, we should discount such gains from our calculation. However, given the company's consistent investment in other companies and assets, we may be underestimating Kroger's earnings power if we discount such gains entirely. If you take a look at the reported earnings for the past 5 years, you can observe that it ranged between $1.5 billion to $3.5 billion. Hence, instead of discounting the $1.1 billion of gains on investment entirely, resulting in the overall adjusted earnings to be reduced to about $1.5 billion, we will discount about half of it to arrive at an adjusted earnings of $2 billion, and this will be similar to the previous year's levered free cash flow level. Beyond Kroger's recent earnings, I want to highlight that the company has been able to increase its dividends payout consistently over the past decade. This signifies the strength of its business, being able to generate strong free cash flow to return to its shareholders. On top of that, the company has been able to buy back its shares pretty consistently over the past decade as well. This is another avenue that the company is returning cash back to its shareholders by repurchasing shares in the market, thereby increasing its per share value. However, if the dividends and share repurchase programs are funded by taking on more debt, then it should be a red flag to investors. But here we see that the company's net debt to EBITDA ratios have been hovering in a pretty healthy range of 2 to 3.5. On the other hand, the ratios seems to be on the higher side recently, so it's something to take note and monitor. But for now, I would say that the company's balance sheet is pretty healthy and management is well aware of its financial leverage and is committed to keep it at the current or lower levels as observed from the net decrease in net debt in fiscal year of 2020. Now, since Buffett is more inclined to investing for the long term, here we will evaluate Kroger's expected rate of return for the long term as well. Understand that in the long term, your return on investment, or what we call the ROI, will simply be the earnings yield based on the entry price coupled with the long-term growth rate of the earnings. Whether the returns are coming from dividends payout, shares repurchase, or retained in the company's book, they will all come from the company's earnings. But of course, the caveat is that management is deploying these earnings efficiently in terms of returning to its shareholders or allocating it for maintaining or growing its business. So, based on our adjusted earnings of $2 billion that we have arrived for fiscal year of 2020 with 781 million shares outstanding, this will translate to about $2.56 earnings per share value. At the current share price of around $40, this will translate to an earnings yield of 6.4%. As for the long-term earnings growth rate, let's use a quick estimation from the past 5 years earnings per share growth rate as the long-term growth rate of the company's earnings. Note that for this case, we will use our adjusted earnings per share of $2.56 for the fiscal year of 2020 instead of the reported $3.27 a share. From this, we can derive the compounded annual growth rate of Kroger's earnings per share over the past 5 years to be about 4.4% per annum. In short, if you are buying into the company now, holding for the long term, effectively you are getting yourself a 6.4% return with a growth potential of its earnings at 4.4% a year. In fact, our estimation is very close to the management's investment thesis, estimating a return in terms of cash payout of 5 to 6% from its dividends and share repurchases, and also a net earnings growth of 3 to 5% from its identical store sales growth, coupled with margin expansion and cost savings initiatives. As for Buffett, we can see why he has been adding to his positions recently, as I believe that he saw its valuation as very reasonable for a wonderful business. Assuming that Buffett bought at an average price of $30 a share, this would have translated to 8.5% earnings yield with the growth potential of his earnings at 4.4% a year. This means that in 4 years' time, his investment would probably be earning a double-digit earnings yield of more than 10% already. As for why Kroger falls into the type of company that Buffett likes, I would say that its supermarket business is strong and predictable, as seen from the many years of steady growth in earnings and returns to its shareholders in terms of increasing dividends payout and consistent share repurchase programs. In fact, Kroger's number 1 or 2 market share position in most of the markets that it is operating in gives the individual supermarkets the economies of scale as the competitive advantage in the local community. It will be difficult to replicate and compete effectively with Kroger for new entrants, as the company can use its scale to compete effectively with these retailers. Moreover, it has a great management, allocating its capital efficiently as seen from its healthy balance sheet, increasing dividend payout, and consistent share repurchase programs. The company also exercises discipline when it comes to investment, spending mainly in its core business that it has strength and experience in, and only in related businesses such as advertising in its stores and bringing that to the online channel, all leveraging on its retail presence. Therefore, I'm definitely adding this great business into my watch list. Let me know your thoughts on this and share with us in the comments below, and remember to subscribe to our channel so that you can be informed once our next investing tip is out. In the meantime, check out the recommended videos here to continue learning so that you can make better investment decisions. Keep learning and happy investing, and we will see you soon.